The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. I want to start out the show today with where we ended the show last Thursday. We had Rich Anderson on at that time, and we were talking about the crop report that was coming out on Friday and how it was going to affect the corn market. And corn was actually down going into that report. And as we mentioned many times, you don't want to go into a crop report in a naked position because of the fact that, bad things could happen. And, of course, it was the largest planting of corn since 1936. That's how they reported it. However, in 1936, we had a whole lot less people living on this planet than we do now, especially in the United States and all the other countries like China and India and every place else, South America. So even though there's a lot more people out there and we planted a lot of corn, we still have to be able to get this corn to market, and it's very, very unusual. In fact, it's almost impossible to go through a growing year without some type of a weather scare. And now we've got corn into new low ground, lower than it was in May of last year and also June of last year. And it's making a really nice butterfly pattern down here at the $5 per bushel level. And so the report's out of the way. It's very, very negative, but I'm assuming that we're going to have some crop scares between now and when it's harvested in October. So I'm going to be a buyer of corn down at this $5 per bushel level. I'm going to risk 10 cents, which is $500, and I'm going to see how the old crystal ball turns out here, because this is a nice butterfly pattern coming in where we wanted it, and we'll see if that's the case. Now, the price of new crop corn, that's the corn for July and also for September, that is trading for $1 a bushel higher because there's just none of it available. The crop was so small last year that they're scrambling around to try to find corn, for those people that need it. And those contracts were down very, very little or even up somewhat. So that's my story on December corn. The report's out of the way. The pattern is completing at a lower level than I had originally anticipated, but to me, I think that's just a way of giving corn away at a terrific price. So we're going to be looking at around $5 on corn with a stop below the $4.90 level, so we're risking about $500. That, in fact, makes you a farmer of 200 acres of corn, and you don't have to buy the acres, you don't have to buy the tractor, you don't have to buy the seed, you don't have to go to the bank to get the financing. You don't have to hire anybody to put in the fertilizer or all the other stuff, the herbicides. You just have to buy the contract, strap on the saddle, and hang on. So we'll see if this is going to work. We'll follow it as we go through, and if we do get filled, we'll certainly take a look at that as something that is going to be very, very important. Now, the next one that we want to talk about, and I think that we have started what I think is going to be the largest rally that we've had in gold since 2012. In 2012, we had a rally in gold that went from $1,524 up to $1,800. It rallied $275 per ounce during 2012. That's on the weekly chart, and I believe we're going to have a rally larger than that from where we started on Friday. Friday, we came very, very close to the exact 61% retracement from the 2008 low. That number I had calculated at 1170. We got down to 1177 on the gold, and since that time we have rallied $80 an ounce in a matter of hours, folks. I mean, this thing has really come out of here very, very strong. It's just been very, very strong. Now what we have to do is see if we're going to get a pullback in this gold, and we probably will, because the bears are still they're shell-shocked, and anytime the market starts to back off a little bit, they will think that, the bulls are shell-shocked, and they'll think that the market's heading back down again, and so they'll sell into that retracement. Hopefully we'll get about a 61% retracement of any move that we've got going here, and that'll give us a low-risk entry technique, into the gold market. Since we're talking about entry techniques, I wanted to bring up the just to show you what happened on Friday, because it was very, very interesting on a technical basis, because I was watching the gold at that time after we'd hit that number, and over the period of the next several hours in gold, it was actually about 8 hours, gold had rallied up to the 1211 area. It rallied well over almost $50 an ounce. And then it made a perfect Gartley retracement down at the 786 retracement down at the 1186 level. And in a matter of just a few minutes, the market just exploded to the upside, and it's been doing that all night long and all the rest of Friday, and then all night Saturday, all night Sunday. So it tells us that this rally is definitely for real in gold. I think it's got a chance. It has legs in it. The main reason for that is that there is so many people that out there that have given up on gold that that's probably when you want to be looking to take a look at it from the long side. The old adage from trading on the floor of the Chicago Mercantile Exchange is you got to buy them when they're crying and sell them when they're yelling. And boy, believe me, they've been crying in the bull camp for gold. And now we've got a potential for a really big rally in here. So my strategy now is to watch what the corrections look like. We should get a nice ABCD correction, sometime in the next few days, because these markets are not going to go straight up. They will have their corrections, and that's what we're looking to do, is to find that nice ABCD correction that will give us a chance to, to get long, that particular pattern of what we want to be looking at. Now, the same thing happened. I want to show you the same thing in silver, because silver has been acting, very, very strong also. And I posted into Tiger TV the 60-minute chart on silver going back over the last few days, because it also showed the butterfly pattern down in the silver market when it was trading around $18.20. We've now rallied over $7,500 without very much of a correction at all. We've had a couple of corrections around 50 cents, but what we're looking for is if we can get a correction of about 80 cents in the silver down to around the $19 per ounce level, that would give us a pretty good place to enter the market, and then you'd have to stop it below, the $18 per barrel level. The reason for my bullishness in the gold, and not so much silver, because I don't trade silver, it's just too volatile. Actually, it's just illiquid. It doesn't have the same liquidity that we have with gold, because gold trades 6 times what they do in silver, so gold is much easier to trade, and by far, the best speculative vehicle among the precious metals, without a doubt. Silver sometimes has periods of illiquidity where you can get your stop run by 30 cents or even more, which is $1,500. That's not a very warm feeling. In gold, that just does not happen. So that's the main reason why we trade the gold as opposed, to the silver. That's the main thing that we're watching here. So just to summarize, I think we've made a major bottom here in gold. I think the rally could easily match what we did in 2012, which was $275 per ounce. It's not going to happen overnight, but I think it's got a potential for happening over a period of several months. And this is one that will be on our watch list to see if we're going to be able to do that. When we've looked at these long-term stock indices, gold, silver indices, they've also, have been down at major support levels with these large ABCD patterns that are there, and that tells us that we are something very, very close to what we think is a, really major spot to be watching the price of the let me get this right. The price of gold going higher, because of the fact that we have had such a strong move, to the downside, and now we're getting ready to see if that's going to be the case. Now, I want to switch over to the stock market a little bit, because one of our friends from New Zealand, who is a very astute student of the market, probably one of the best that I've run into. I was fortunate enough to work with him over the past several years. And what he's done is he has forwarded on to us his chart of the all ordinaries, the Australian stock market. And going back to 2001, he's pointed out 3 of these expanding 5-wave reversal patterns that have occurred. The first one happened in 2001 through 2003. It was a beautiful expanding triangle. 0.5 in 2003, led to the big move into 2008, where we had another of these 1, 2, 3, 4, 5 expanding wave triangles right at the top in October of 2007, and that led to the big drop. And then we've had another one just form over the past 4 or 5 years, and that's the one we've been talking about with the Dow Jones and with the FTSE, and also the DAX and the NASDAQ and the S&P and the New York Stock Exchange Index. It's that 5-wave reversal pattern that is so very, very bearish. And not only that, but is one of the more accurate of all the patterns that we have as far as accuracy, because this thing works better than 85% of the time. You really have to search for one that fails. I mean, they're there, but you certainly have to search for them. But if you look at this chart, which is a monthly chart going back, 13 years, you're going to see 1, 2, 3, 4, 5 different patterns that are all the same patterns. That's the 5-wave reversal pattern. You'll see that each one of them was a substantial winner. And not only that, but it puts you right at where you're supposed to be when you're at wave 5. And we had that happen, last month in May in the New York Stock Exchange and the Dow Jones and all of the others. So that's what we're looking at on a pattern basis from Australia. It's the same pattern that I've been posting in the Tiger TV and also in my newsletter, since early May, that this is what I think is the mother of all tops. We've got to take a break here, folks. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. Funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I'm going to be talking about the VIX index. I enjoy following Basil because he has such a good insight into what the VIX is really doing, and what I'm trying to look at is where I think the support points are with VIX. But if you look what's happened over the past 10 months, you'll see that it's had some very nice cycles that are in there. They vary anywhere from 60-day all the way through 35 days. But they've been very, very accurate, and we're over one right now. The last high that we had when we were making the Gartley pattern up around the $21 level in the VIX, which was at the 786 retracement of the high from December, that was on the day that we had the full moon, which was on the 23rd, 24th of June. And we have since been rallying now for 5 days, every day last week, and then again on Monday. The most we usually get on a rally into a lunar event like that is 5 to 7 days. So this is day 6. The most I would expect would be either one more day tomorrow. But that's my expectation. And remember, expectations are your greatest form of frustration, because when your expectations are not filled, that's when you really become frustrated. So try not to expect what you're going to happen. Just react to it. Trade what you see, not what you believe. This was one of the things that we talked about corn, on Thursday, because you had this big report coming in, and even though we were very, very bullish on corn and it made us a couple $1,000s, and we did buy it back, we decided that it's better not to go into the report, with a position, especially when the market is moving down, because a lot of these things are leaked. This used to happen all the time when we had Secretary of the Treasury Earl Butz, who was from Indiana. He always had inside information of where the crop reports were going to be, and I know he traded off of that because his broker was Harry the Hat Lawrence, and Harry was always in there during the time when before the crop reports, getting ready to do something. In fact, it was a joke on the floor there that it looked like Earl Butz was buying or Earl Butz was selling because of the fact that Harry was filling his orders for him. The next one that we want to look at is I want to take a few seconds here and go in and get the, just give me 1 second here to get it ready. And that I wanted to show you was the Dow Jones transportation. We have, we've had the big ABCD to the downside that came in on the 24th of June. And then we've had the rally back now that we're back up to the 61% retracement, and that's where we are at that point. Someone asked me a question about natural gas, and I have not done natural gas as yet, and I will try to do that right after the break. I'll just put a chart in for natural gas to take a look at it. It's something that I don't trade that often, maybe several times a year. I trade crude oil all the time, but not so much with the natural gas. But the Dow Jones transportation is held up, very, very well, and all we're doing now is to see what the next move is going to be, to the either up or down. Now, we need to talk a little bit here about the S&P cash, because here again we're getting up to this 162 level, which is the 61% retracement of the move that came off of the low of last Monday. And like I mentioned before, usually these lunar cycles, when they hit right on the money like this one did, all they get is a rally of usually 5 to 7 days, and today's the 6th day, so the most we would be expecting would be one more day and then probably getting ready to move to the downside. That's the way that the chart picture looks, at that particular point when we're watching the S&P cash, on a daily basis. I believe that top that we have put in May is not going to be violated for quite some time, and it will be, something a lot more sinister coming to the downside once we take out the lows of when and if we take out the lows of June 24th, which was last Monday, the day following the full moon that we were watching at that particular time. Now, we're almost at break time already. We need to, when we come back from the break, I'll start it. Well, we're going to take the break now. 877-927-6648.
With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter, Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks. 2 weeks ago, in the newsletter, we were featuring the euro versus the U.S. dollar because it was completing a perfect Gartley pattern at the 134 level. It was making the traditional AB equals CD pattern that we know and love. But at the same time, it was the symmetry that was there. In other words, from the low we made in April to the high we made on May 1st was equal to the low we made in late May to the high we made in June in the BC legs being equal. And the pullback that we're experiencing today and also experiencing Friday was down the exact amount. In other words, the last BC swing was equal to the BC swing that we had since we topped on the 16th of June in the euro. Now, this means that we're going to get a rally, at least that's what the technical part says. How much the rally is going to be and how long it's going to last is anybody's guess. I don't know the answer to that, folks, but I can tell you something with 100% accuracy. Nobody else knows either. So what you try to do is to, follow it each day to see how the rally is unfolding, and that'll give you an idea if the market is going to rally, 5 days or 10 days. Then you have a better chance of determining, whether the market is going to actually, do that particular move to the upside. So we'll see, if that's going to happen on a longer-term basis anyway. Now, the next one that is completed here, I want to show some of these currencies because they're related to the stock markets of these countries too. But I wanted to show you the the chart for Canada. This is the Canadian dollar versus the U.S. dollar. And as you can see, we've been in a pretty strong bull market since last September. And now we have completed a 3-drive to a top pattern up here at that 105 level, in the 105, 106 level in the Canadian dollar versus the U.S. dollar. So this is one that we'll be ready to look to the short side, to see how much the market will pull down if it gets to that point. But right now, we believe that the U.S. Canadian dollar is in a sell mode. The $64 question is it going to remain that way, or are we going to go into a really, really bullish Canadian dollar versus the U.S. dollar? Now, the next one that I'm going to talk about, there's a big election going on in Australia. I think it's actually over now, and the fellow that was in there before, Rudd, has taken over from the young lady that was running the company, and we're just completing a bullish Gartley in the Australian dollar versus the U.S. dollar. That goes back to 2010 because this is a weekly chart. That's telling us that, maybe things aren't nearly as bad in Australia as the Australian dollar versus U.S. dollar is telling us. This might be a spot where the Australian dollar starts to gain on the U.S. dollar. So those are the patterns that we're looking at, are the major ones on the currencies, and that's, what we see, at least looking, way down under, what those charts look like, and that gives us an idea of where we are. Now, the next one is really important because we just hit it today, and that is the Japanese yen versus the U.S. dollar. This is the Nikkei Dow, and if you'll look at this chart, it's a perfect technical chart. It's a daily chart of the Japanese yen versus the U.S. dollar. It shows the head and shoulders pattern that has been presented since April. We went up and made a high at a expansion number up into May the 13th. We came down to a 382 retracement of the big low, and since this time we've rallied up, and today we've hit the 61% retracement of the that move that we had in from May down into June. We made a 61% retracement. That completes a perfect head and shoulders pattern. Now, this could fail, and if we get much above 101, I would certainly think that this pattern has certainly failed, and it looks like we could be going up and making new highs in the Japanese yen versus the U.S. dollar. But just looking at this chart, we're right at the 61% retracement. It's been very, very orderly, and not only that, but it's taken almost a solid month to get here. It's been up almost 13 or 14 days to get into this, 61% retracement of the high, which puts it into this major resistance area. So that's what we're looking at. The dollar, when you add all this together and you look at the euro and you look at the pound, you look at the Canadian, the Australian, and the Japanese yen, the dollar is at the moment of truth here. It's going to have to move rather dramatically in order to keep the trend moving. And so this is what we are focusing on when we're looking at some of these cross rates, is to get us an advantage of where we think the dollar is going to go. And that's why when you're trading Forex, you have to treat each pair separately. In other words, the Australian dollar is totally different than the Japanese yen versus the U.S. dollar. So if you're trading the Australian dollar versus the U.S. dollar, it has nothing to do with the Japanese yen versus the U.S. dollar. Those are different countries, different philosophies, different economics. So those have to be traded separately. It's one of the things that make Forex so wonderful, is the fact that you've got so many things to choose from on a long-term and short-term basis, that it gives you a chance to select what you like to trade and not worry too much what everybody else is really looking at. Now I want to get to the one that I think has the potential to be another move down like we had in gold, and that is the Treasury bond market. What I've done is I posted into Tiger TV today, I posted the 30-year Treasury bond chart on the weekly basis going back to 2009. You can see the huge swings that we've had. And on top of that, I superimposed the Treasury notes, which are the shorter-term paper, 10 years or less, and that shows that, we have been looking at higher interest rates in that market for some time. We did hit a major bottom, and we will see if we can, I got to make one little technical correction here and see if we can get the charts into Tiger TV, because I didn't do something correctly, and I wanted to get that done so the folks that are in Tiger TV, and then also those that are in the Tiger's Den, which is a great place to go for trade ideas and some really smart people that that are very good at this. However, the important thing to look at on this 30-year Treasury bonds on the weekly basis is that we broke below the 786 of the 2012 low. Our interest rates on that 30-year bond are now higher than they were in 2012 in January. That's the first time that's happened, folks, in 3 decades. Interest rates are going higher. It doesn't make any difference what the Federal Reserve is going to try to do. The market is telling us that the interest rates are going higher. How? I don't know. What I'm watching here now is to watch to see what is going to be the rally that we had since early March. We came straight down for 1, 2, 3, 4, 5, 6, 7 months. Last month was the first month that we actually closed up on Friday. So I'm looking for a rally somewhere around the 140 level in the Treasury bonds. And if that occurs, it has a setup that if it starts to cascade to the downside, interest rates are really going to spike. And believe me, we haven't seen a spike for many years. You have to go back about 6 years in order to see where we've had a huge spike in interest rates. Always the spike has been to the downside, but this one could actually surprise people. So what I'm trying to say here is that the bottom that we made last week in the Treasury bonds at that 133 level, and now they're trading at almost 136, once that bottom is taken out, we are starting a very, very bearish Treasury bond market, i.e. higher interest rates, not lower interest rates. That's what it looks like on a technical basis. I don't understand Chairman Bernanke when he talks, but most other people don't either. And I hang around some pretty smart Wall Street types, and when they tell me they don't know what he's saying, I don't feel that bad, because it just doesn't make sense in what he's doing, and it's just one of those things that you makes yourself really concern yourself for. Now, I went from a weekly chart that we just did on the Treasury bonds. I've now gone to a daily chart on the T-bonds. It goes back showing the low from last year, and you'll see that we've completed a really big ABCD pattern down here at that 133 level, and we are in the midst of a pretty strong rally into this level. And what we want to do is to see how far the market can take us. The last time we've had these rallies in the Treasury bonds, they've only lasted 4 or 5 days. We had one that happened in early June. We had another one about mid-June, and that's pretty much it. The rest of the time, interest rates have been going higher, not lower, since April of last year. And believe it or not, the price of stocks went up even when interest rates were rising. The reason why is the Fed has it pegged at 0.25% interest rates, for the bank to get it, but that doesn't pass on to us. The bank has to, put their 9 or 10 or 12% on it, and make that profit, and that makes it really good. Not only are they too big to fail, they're not too proud to take the profit. So I think that's a really good analogy of what's happening with the banks. The $64 question is how long it's going to act. Now, the last chart that I wanted to show you as far as interest rates is the chart of the Treasury notes on a weekly basis. It shows that we've had a pretty strong down move from that head and shoulders pattern that occurred over 2011, 2012, 2013, and here again it was a perfectly symmetrical pattern at that point. Someone has asked me a question, where would I put an order for TBT? That's the ETF for the Treasury bonds. What I would do is I would write that order up, I would put it in an envelope, and then I would take it out to the trash bin and put it into the trash bin, because I'm not going to trade the ETFs for the Treasury bonds. Be my guest. I don't think they play fair in that market. That's just my guess. I think this might be one of those weapons of mass destructions. I don't know, but they're not getting me involved. I'd rather do the Treasury bonds futures themselves, take the little bit of extra risk, and have the good liquidity that we have with Treasury bonds and Treasury notes. But I don't like ETFs, and that's my bottom line. These people put these contracts out for people to use, but I don't think that they're being fair, because a lot of times you'll be right on the market and that ETF just does not work the way you think it works, and that's not a good thing. That's something that I think is very, very important to us to realize. Now, I have one other chart here that I wanted to show you folks, and that is I put a chart similar to this together before. Actually, I get this from a website from the Federal Reserve that shows where New York Stock Exchange investor credits are and stuff like that, how much margin they're using, and it shows the tech bubble of 2000, and it shows the housing crisis of 2007 and where we were in April of 2013 when we were supposed to have another crisis. But the thing that's important is if you look at the credit balance chart, you'll see it has that same expanding wave triangle of 1, 2, 3, 4, 5, and we've already finished wave 5 and have already started, to move down. And I think this is the pattern that is going to be the one that is going to be the biggest of the things that we're looking at, over the next several weeks, years, and months. Years, months, and weeks, months, and years. In my opinion, that's what I think we're going to be looking at, that we are going to get starting down into some of these markets. I know that some of the things have improved on the employment front, but frankly, I don't think they've improved not anywhere near where we were before, because we lost so many people out of work, and these folks have not been able to get their jobs back. Plus, they've not been able to start a new trade or a new education to try to, do something with their lives, and that's a very, very negative situation. We happened to go to a daycare recently over the last few days, and it was amazing to see, the quality of the care that was there. But then this was a very expensive school, and not for me or any of my kids, but it was just showing me what was available. By the way, those of you that follow the news at all, I live here in Arizona, and up in the mountains, about 4 hours from where we live, there's been a terrible fire caused by the extreme heat that we've had, and we lost 19 firemen last night, young fellows that have given their life to try to control the fire. So put some prayers out for them, folks. We got to take a break. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rose, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we've got a call from our friend in Philadelphia. John, are you there?
Good morning to you, Larry. Listen, thank you so much for sharing with us those ideas of a potential bottom in gold.
Yeah, potential is the key word.
Yes, indeed. To that end, I wanted to share something supplemental for you. In addition to gold and silver, I'm also tracking the other metals, palladium, copper, and of real interest to me here is platinum. And for the benefit of you and your listeners, I posted into the Tiger's Den the weekly chart of platinum. What I wanted to just point out, Larry, is this, that platinum made new swing lows last week with gold and silver and took out the prior swing lows of December 2011 and then the several lows of 2012 and 13. The interesting phenomena that I wanted to just share, and it may mean something, of course it may not, but here it is nonetheless, namely the weekly platinum chart bottomed at 1289 last week. We're back $80 above that now at 1376, and of interest to me is the fact that price is now back above those prior swing lows, leading me to think it's very possible that the platinum decline to a new low last week was a fake out, was kind of a bear trap, that is the bottom. So I just wanted to share and actually ask, when you look at that, do you come to the same sorts of conclusions?
I saw that, John, because you brought it to my attention, and it does look, very, very interesting because platinum used to sell at a huge premium to gold, well over about $900 premium, and now the premium is, dissipated. And at one point, platinum was a discount to gold. And but you're right, it is starting to turn. There's no question about that. It does look a lot more positive than both gold and silver. It's a lot smaller market, but the fact that it's used in so many things related to automotive that you have to pay attention to it, in my opinion.
Excellent, good. Well, I just share that for what it's worth, and I'm with you, at least looking for buys and trades from the long side in the gold, silver, and the platinum for what it's worth.
It's been a long time, John, since we've seen this much bearishness in gold and silver. You have to go back to 2008 to see that much bearishness. In fact, it's worse then than now because our percentage drop was much greater, and of course the dollar amount was much greater because we dropped well over we dropped almost $800 in gold. That was as high as gold got in 1980. It only got to 865, and we lost about $800 of that over the last 18 months in gold. So it tells us that the volatility has increased here, and I believe that's what's going to give us this huge rally that we could be seeing in the gold market.
Excellent. Larry, thanks again for what you did today. We appreciate it.
Thank you very much for calling in, John.
Right. Bye.
You bet. It's always a joy speaking to him because he's a real student of the market and does some incredibly good things. And fortunately, he shares them with me, and I'm able to bring them into the radio show. He looks at the open interest and volume also, and we double check each other on these figures to make sure that they are correct. But it looks like we'll reiterate this. It looks like that we are making a major bottom here in gold. That we've been expecting it around this 1170 on the weekly charts. We had 1177 on Friday. And then also the price of corn. We had the very bearish crop report come in on Friday during market hours. They took corn down just about $2,000 into new low ground. It's near $5 a bushel. Nearby corn is $6.25 a bushel, so it's still in demand. And the odds of us going through a year without a crop report, crop potential failure is very, very small. That's it, folks. Live every day in an attitude of gratitude, and may God bless.
Hi, folks. I'm Steve Rhodes with TFNN.com, and the trend is your friend until it changes. A free special report is now available on the homepage of TFNN.com, and if you have money in the markets, this free report is a must. If your strategy is buy and hold, this report is a must. If you're a day trader, a swing trader, a Forex or options trader, or just getting into the markets, this report is a must. And it's the second best gift you'll ever receive. Look, if you buy a stock and the general market is trending in the other direction, you've reduced your odds of buying at the right time by 70%. Instead, let me teach you how to get that 70% Advantage Plus. The Plus is a free trial to my daily newsletter service, Mastering Probability. There's no upfront deposit, no charge to your credit card, and I compress decades of education into each daily newsletter. This is a limited time offer, so act now, and I'll teach you how to take the trend and turn it into your best friend. All the details are on the homepage of TFNN.com. Act now.